Hi folks, Mike Lynch here from Barna Financial Group, where my team helps you create and implement plans to help you finance your life's great desires. Now today's video is kind of a niche video. It's not going to apply to most of you, not going to apply to a lot of you, but it might apply to some of you at some point in your life or someone you love. And it's really this simple. We don't want you to waste the tax code. We don't want you to waste your low income years or any income year that you can manufacture as low income. We run across people sometimes. They're going to retire early. Maybe they have a small pension. They're taking money out of their bank accounts to live, so that's not taxable income. They're not yet having to take out their RMDs, and they're all proud. They're all proud. They're like, look, I'm paying zero federal income tax. And then I say, are you sure you want to do that? And they say, yeah, I'm sure I want to do it. I want to pay any income tax. And then I look into the future and I project them. And in the future, now they're going to be required to take money out of their retirement plans. Maybe a spouse's Social Security is going to kick on. And all of a sudden, they're going to find themselves paying 22% federal marginal rate. So they're paying zero now, they're going to pay 22 later. So they're like, wow, I didn't know that. So what's the solution? Well, the solution is to be smart and strategic about the income tax brackets. Let me take you and show you an example. This is a pretty simplified example. And this is part of the area where you're going to do this planning right. You got to plan for a lot of stuff. If there's Social Security involved, you got to plan for phase in and outs of taxation and Social Security based on the new One Big Beautiful Bill Act. Extra money for Social Security for the senior deduction designed to help Social Security be less taxable. You got to plan for phase out to that. So there's a lot going on. But what I'm going to show you today is the basic structure of how to think about it. Okay, so this, folks, is a stylized example, but it's literally going to be, what I'm going to show you is how we actually do it. So this table, I call it Operation Use the Bottom End of the Tax Code. Because, folks, you don't want to waste, certainly don't want to waste your standard deduction because that's a 0% tax rate. I don't think you want to waste a 10% tax bracket, and likely you don't even want to waste a 12% bracket. But let's just take a look at what might happen if you're just simply happy that you're not paying taxes. In this case, example, this person has $20,000 in income. Let's call it a pension, and let's say they have a modest lifestyle. They're happy, don't have a lot of bills, and they got money in the bank, they got cash, maybe they even got a stack of hundreds in the safe. They are in good shape, they don't need additional income. So when I see them, they say, well, we got these retirement plans, we want to invest, but we don't want to take any income now. I say, okay, well, you're taking $20,000 in income, but you know that your income taxes based on your standard deduction of $23,750, that's a standard deduction of $15,750. That's $2,000 for being over 65 and single, and that's another $6,000 because you're a senior citizen based on the One Big Beautiful Bill Act. So you realize that your taxable income is actually negative $3,750. So what that means is that if it's a refundable credit, the government would be paying you $3,750. Or another way of saying that is you could take an additional $3,750 and pay zero tax. So why wouldn't you do it? Well, the only reason you wouldn't do it is if you were just so lazy or your time was worth so much that you felt like it wasn't worth the time to call up the IRA account and put another $3,750 in your account, okay? So this is clearly a suboptimal situation. So what's the solution? Well, here's a solution. You take a look over here at the tax brackets and you say, okay, well, after the standard deduction, I can take another almost $12,000 and only pay $10,000 on that additional money. So in this case, what we do is on our income, we would say, okay, we got our $20,000. What we can do is add another $15,675 to the income. That's here right here. Now our income is $35,000. Our standard deduction is $23,000. Our taxable income is $1,195. So if we move over here to our income tax chart, what we see is that at $11,925, we just filled up the 10% bracket. And if we fill up the 10% bracket, what we're going to end up owing in tax is a whole $1,193. Now you look at me and say, Mike, why do I want to pay $100? $1,193 today. And I say, well, Joe, the reason you might want to do that, because if you don't pay $1,193 today, later on, you might be taking it out in the 22% bracket, right? And now, instead of paying $1,193 on that dollars, you're going to pay more than twice that. Does that make sense? We getting what I'm picking up? Good. All right. So, in that case, too, let's look at what the actual taxation is, because now the actual tax rate on this is not 10%. Remember, it's 10% on only an additional money. The actual tax is $1,193 divided by the total amount of income, which is $35,000. So the actual tax you pay coming out of here is not even 4%. It is 3.3%. Does that, you see what we're doing here, right? It's a 3% tax to get the money out. Okay. Now, you may want to keep going, depend on where you are in the tax brackets, or where you are in your life, where you see yourself coming out in the future, right? Again, a person could have low taxable income. They're taking money out of they got a small pension, they got money in the bank, they don't have a lot of nice needs, but they might have $1 million in an IRA that's going to become $2 million when they're 73, and it's going to put $80,000, $90,000, $100,000 out in their income that they don't need then. So what they might want to look at is say, you know what, I don't even want to waste a 12% tax bracket, right? Because if I stay under the 12% tax bracket, I keep my dividends tax at zero, I keep my capital gains tax at zero. So that's another sweet spot that we oftentimes look at for clients, and you might want to look at for yourself. So now in this case, what you would do is you would say, okay, well, let me fill that up. I got to figure out how do I get to the top, which is $48,000. So now I could take another $52,000 out. If I took another $52,000 out, for a total income of $72,000 against a standard deduction of $23,000, now we see I have $48,000 in taxable income. Now, if I go over here and apply it to my tax brackets, the same thing that I did before. I say, okay, I got $48,000. I subtract out the bottom of the bracket, which is $11,925, and I actually multiply it by the bracket. Those of you that love Excel, you like to dork out on math, you'll see it. That gives me another $43,383 in tax. And so at this point now, you've topped out your 12% bracket. At this point, you might say you're paying 12% in tax, but you're not. What you're not paying is any tax on dividends and capital gains, so you've kept all that money tax-free, and your total tax is $5,579. Again, what's your average tax rate? How much are you getting your tax out? How much are you getting your money out? What was your price for you to get your money? Well, you take the $5,579 and you divide it by your total income, which is 72, and you see your average tax rate there is still only 8%. Again, you ask, well, why do you want to pay 8% in taxes if you could pay 0%? And the answer is you might not want to pay 8% in taxes if you could pay 0%, if you're going to continue to pay 0%. But if in the future you're going to pay 15, 16, 17, or 18%, you might want to pay 8% today, get that money out working for you. And if this is IRA money, it's pre-tax money that you're taking out, you could actually get it into a Roth IRA with the Roth conversion and then never, ever, ever pay tax on it or any of the gains again. So folks, I hope you found this video interesting. Again, this is a niche situation. It's for somebody who has a lot of taxable investments or pre-tax investments, IRA investments, but nevertheless finds himself in years of having low adjusted gross income and therefore low taxable income. They may be losing the opportunity to take advantage of the bottom end of the tax code. So it's a strategy to pay through 2% taxes this year, 8% taxes this year, so you can avoid 15 to maybe 20% tax in the future. And with that, folks, as always, I've given you the tools here. You can do it yourself. Maybe you can call up AI, go into Cloud or ChatGPT or whatever, see what they're going to do for you. But if you want to spend your time doing something else or you want a little help with it, you can call us up. My team will be happy to help. We'll focus on your finances so you can focus on your life.